Per usual, everything on this channel is for educational purposes only and it's not intended as financial advice. It's Macro Monday. Let's take a look at some charts. I got some trading ideas on Tesla coming up, CORZ, Meta, going to dispel some legacy bearishness. But first, the crypto global flows from James at CoinShares coming in at a positive 500 on the week, thanks to J Powell at J-Hole. Most of that came in through BTC, obviously, in the US, iShares, through BlackRock, outflows from Ethereum, again, last week. And anywhere else on the world that matters, Switzerland, a little bit, Hong Kong, a little bit, Germany and Sweden, continue to sell. Looking at the Bold report, cumulative 30-day flows, we're back down to baseline, essentially. So we're not seeing what we want to see, which is just continuous GBTC 2020 into 2021 type of activity pushing price higher. And it's definitely a chicken or the egg thing, because what's going to push price higher here if it's not the ETFs? Is it going to be retail? Is it going to be some risk thing broadening out, helping us? Technicals still look fine. They look great. They look better than they've looked in a long time. I think we're back to 63.5 or something like that. But we're very much in this holding pattern that we've been in for the past several months based on seasonality. Again, September is not a month where you're expecting anything in a big way. Based on where we're at from the cycle low, I wouldn't expect anything until October. Based on the election, I wouldn't expect anything until after November. So we could be in this pain consolidation for a few more weeks, as in maybe 10 more weeks, right? It could get very, very painful. We could make a right shoulder here. We could do all sorts of fun stuff that is not breaking out and still remain on the bullish side of trend metrics. In the meantime, though, we are seeing altcoins broaden out a little bit. If we look at the breadth metric, which is Binance coins above their 50-day moving average on Capital's website here, that has spiked quite a bit. You can see on the 200-day moving average, we're still way down there. And as far as alts outperforming BTC in the past 90 days, basically nothing. And if you're DCAing into alts, or if you're waiting for alt season or whatever, it's going to take some time, because you want BTC bullish first. You need that most definitely. Alts are not going to move on their own. That just isn't going to happen. Before we go any further here, on the legacy side, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PBI, DBA, Kraken. As I was saying last night, if you don't like trading the USD pairs, the BTC pairs are an option, the ETH pairs are an option. A lot of this stuff still looks really good. It's just, you got to give it time. You got to give it maybe 4, 6, 8, 10 weeks still before we see anything start to get moving. Some of the AI related junk has been moving because we've got NVIDIA earnings this week. That's probably the most important event of the week outside of PCE. So it's not like this is some trade idea, because that's probably done for the moment. I think last time these coins sold off into earnings. But for the most part, just scrolling down the list here, there's just not a lot of positive on alt BTC pairs. And that's where you want to be if you're being honest with yourself, because if you're sitting in ETH for 2 years, you're down 50% relative to BTC. It's just math, right? It's just math. Looking at the calendar for the week, durable goods, which isn't something I pay attention to, but it's something the macro bears, these little itty bitty data points they love to point out, was very positive this week. This is like refrigerators and sales of cars. We got home price index, consumer confidence, GDP, PCE, and NVIDIA earnings after the bell on Wednesday. The jobs numbers will probably be more important going forward than inflation, just because that seems to be what the Fed is focused on. We do have initial jobless claims on Thursday. Looking at GDP, hasn't really changed. It's at 2%. Certainly isn't negative. A lot of the recession calls are going to be backward looking anyway at the data, much like that massive revision in employment. So you definitely need to look around at other stuff, as many people have been. They're looking at credit card delinquencies, mortgage delinquencies, debt burden in general, but we're not seeing it on the bigger metrics yet as far as the recession calls are concerned. Looking at true inflation, we're down still below 1.5%. We're just in this holding pattern down here. This is the future of CPI. This is the future of PCE. Looking forward, PCE for this month, we're now 26 days in, sub 2.6. PCE is just about there, core as well. So we're headed in the right direction. This isn't over for inflation. There's still people calling for reinflation based on shipping or whatever else. If that happens, we will see it in true inflation. It is the most sensitive of metrics for inflation. And if it's not there yet, it hasn't worked its way through the data yet. It's just that simple. So, you can guess and say, yes, we're having issues in the Red Sea. We're having issues XYZ reason or region, but it's just not showing up in the data. We're not seeing that just yet. Looking at the CME tracker tool probabilities, 100% chance of a cut in September. Currently, it is at a 25% or a 25 basis point cut. That's what it's favored. I think at this point, we're close enough to the meeting where that's what it's probably going to be. It's probably not going to be a 50, even though I'd argue because they had no meeting this month and no meeting in October, I don't see anything wrong with a 50, but we may get a 50 in November, day after the election. We'll see, but cuts are definitely where the market is at and where Powell is at the moment, and that's why things have started to move, including yields, which have moved down continuously here at the lowest point in the past 9 months. The front end is obviously pinned to whatever the Fed decides that rate will be, but that will come down, and we should see eventually an uninversion of the yield curve. That will still probably take time, but the belly of the curve way down, and the long end also still down, but this is still very much inverted. And if we're talking about when recession, that comes after the uninversion. So we haven't seen that yet. It's not to say we won't see a recession, we won't see a mild recession or whatever, right? That's just saying the metrics just still don't support that. So it makes sense that markets are roofing because unemployment is still at a palatable level based on their metrics. Okay, I get it, but it's still at 4.3. We may see a jump this month to 4.5 plus, and that may push the September cut to a 50. But yield curve still very much inverted at the current point in time. Looking at job openings per unemployed person, this is also back to pre-pandemic levels. A lot of these metrics are back to pre-pandemic levels. So any dislocations we had in the jobs market has corrected itself. And this is what Powell has mentioned and doesn't want to see continue to deteriorate with unemployment. And like I said last week, every day it's this macro edge account on Twitter. Every day it's a new company, more layoffs, 5%, 10%, 5,000 people, 2,000 people, whatever. So the economy is still quite tight in that regard. We might not see that in asset prices, but we're certainly seeing that for businesses. And just because they're starting to cut certainly doesn't mean that's going to solve all the problems. And that's why people are so bearish, because they're just assuming this is going to be a recession and it's over and there's nothing they can do. That may be true, but again, we'll see that. We'll see that in the markets. We'll see that before things go to zero, as the doomers seem to think. There's also a ton of money sitting on sidelines. And the question here is obviously 6.4 trillion. Okay, is that going to come out quickly, slowly? This probably comes out of money markets slowly, despite rates starting to come back down. 5% is still pretty good. Just as 5.25 right now is pretty good. And it's probably going to take like a 3 handle on rates to bring a bunch of money out of money markets. So I wouldn't be surprised if we continue to see this go higher despite rates coming down. I wouldn't expect that to get drained very quickly. On the housing front, still seeing a ton of pain relative to the median monthly mortgage payment. Again, despite rates coming down, despite mortgages coming down slowly, this stuff's going to take time. Everything's going to need to reset and reprice, because now all of a sudden you're going to get all this demand. Now that rates are down and you've got houses getting repriced, 7% of listings had drops last week, the most over the past 4 years. So there's going to be a lot of volatility in mortgages, in prices, in supply and demand. because everybody's been stuck. They've been unable to move. Rates are too high. Nobody wants to buy their houses at the prices that they want to sell them at. And fewer people can afford this monthly payment, right? So housing affordability may take a while to course correct. And that probably results in just house prices coming down in general. And we're already starting to see that in Florida, in Texas, in California, in certain pockets of the country, for sure. Looking at the dollar on low time frames, we're still holding at that 100 psychological level. There is a bullish divergence here on the 4 hour. So I don't know if I really expect much more this week. My guess is we probably consolidate around that 100 area. Maybe this goes for a little triple bottom attempt back to 101, 102. But I don't know if there's much more in the tank to the downside in the near term, at least until rates come down. Depending on PCE, that may move this lower. Depending on the jobless claims, that may move this lower. Ultimately, unemployment, if that spikes, DXY will probably move lower. But that's not a this week thing. So as it stands here, I don't know how much more of a tailwind we're going to get from DXY in the near term. Meanwhile, we're seeing Euro mooning, and as crazy as it sounds, we want to root for this. On the crypto side, you want to root for any EM currency against the dollar because that means the dollar is weakening. And we are correlated with the euro, we're correlated with gold on the BTC side of things. So we want to see a strong euro, which is crazy, right? But that's what we want because that means we're seeing a weaker dollar. And if anything, gold and the euro typically are a quarter, 3 months ahead of the moves we see from BTC. So to see the strong bullishness here makes a lot of sense considering, DXY is as weak as it is. And this looks very good on the weekly for the euro. So what we want to see here is just continued bullish moves past 112, ideally to 120, 122. We'll take 150, right? Whatever. The higher this goes, the better for BTC. UJ also moving lower. Everybody's sort of fighting the last battle. They're like, oh man, the carry trade's going to blow up again. It's like, well, it's hard for that to blow up to the same degree that it blew up the first time because it was more of a surprise. There was more leverage. There was basically a squeeze on that leverage. Sure, did some of that get put back on after the BOJ backed down? Probably, but not to the degree it was baked into the system previously. Based on positioning, the carry trade is over is a concern. The positioning has gone back to neutral on shorts versus longs on JPY. But this looks bearish just as it should based on dollar strength. As far as oil must have heard me talking about it yesterday because it popped up today. I don't know if it was because of things that are going on in the Middle East and the Red Sea and Ukraine. There was some military equipment that passed Polish airspace, and there was a tweet about that. Is there NATO concerns here? Is there World War III concerns here? I don't know. It did move up slightly today. It still looks bearish. It's going to be very wild if this breaks sub 50. I don't really see that happening in reality, but that would be the recession globally being priced in. And what I find funny is the macro bears are bullish oil, bearish the markets when if we have a global recession, I can't imagine oil is going to pop back to 100. So trend-wise, this still looks very bearish to me. And we definitely need to avoid any geopolitical events. U.S. gas prices still slowly trailing lower. And as long as we don't see a massive pop in oil, these should continue to go down throughout the rest of the year. Some places are already at $2.99 or less with gas prices in the country, and that's really good for the inflation story. XLE, the energy sector ETF, super slow moving, still looks okay, which is maybe a problem for the inflation story, but based on technicals, we're still in it on XLE, technically. It's still in the wheelhouse of this ascending triangle. Despite my personal position in this, we do not want to see this breaking up, I don't think, because that would mean probably oil higher, but it's still holding its support down there. As far as the rest of equity market, we've got NVIDIA after the close. Wednesday, obviously, Chewy for some degenerates who trade that. Dell on Thursday. PDD was today before the open, probably why KWEB is down. I'll take a look at KWEB today. And honestly, probably not much else. Campbell's, I don't know, consumer discretionary, some cloud stuff. NVIDIA and Dell, definitely the most important on the week. Looking at the SPY, so as a group, it looks like we have hit the target. We're in this target. We've been in the target for a while. This can obviously keep going like it did into 2021, but my argument is just, as an index, it makes less sense to me to try to take trades up here versus the entry you had in 2023. I see less of a reason to expect continuation without consolidation here. Even looking at these 3 candles, which is a mega bullish pattern, if this does continue, it's going to result in some pretty wild overbought conditions into the election, and that's going to bring even more volatility. So I just think you're better off probably trading the equal weighted S&P, which is RSP. This has a similar pattern, and if you expect broadening out, RSP should perform better than SPY here in the near term. Looking at one of these charts talking about rate cuts, good or bad for stocks. If we do get a recession, rate cuts have resulted in negative 15% post-cut. No recession, close to positive 15%. So you got to pick your battle depending on what you think, or just do nothing and wait for worse data. But just because we get a cut does not mean we see death in the market. And again, we're not seeing that now. This is a Zweig breadth thrust ZBT from Ryan Dietrich. Ryan Dietrich is certainly one of the more bullish people, along with JC Peretz, along with Carlos, is it Carlos Quintanilla, CQ? There's a few people on Twitter that are not boomer or doomer oriented, and they're certainly been pointing out that we still have plenty of bullishness in this market. ZBT is a very good forward return in the next months here, and you can see all those on the chart where we've seen these signals as far as what the ZBT is. I asked ChatGPT specifically, so I wouldn't mess this up, but 10-day period, we're seeing a ratio of advancing versus declining, and this would be, again, a breadth signal. This is strength across equities broadly. You pick some threshold, and like it says here, it's often a bullish signal, and you can see it on the chart. This is what we've seen. These are the forward returns, mostly green, especially 6 and 12 months out, 100% of the time green, almost 100% of the time green, 1 month out. So we're not seeing recessionary concerns in that regard. Looking at election years, according to Ryan, September, October tend to be less bullish, which maybe makes sense because we've got uncertainty going into November. And once we have certainty in November, then we have a good old party time and we figure it out. So looking at the S&P, looking at the Qs, looking at Mag 7, a lot of the things that have been strong, I think are going to need some time to consolidate. And this would align with September, October. It would align with, we might not see a crypto move until November, right? I think it just depends on how certain the polls are and the prediction markets are going into the election. Here's another one looking at volume advancing and declining. And again, as he says, this isn't bearish. We can look at the forward returns. We can look at the number of times we've seen this type of volume action. And it's just very hard to be bearish when we are not seeing everything roll over. We're seeing widening out. We're seeing strength in price, strength in volume. It's just not happening. On the bearish side of things, and this is from JC, large cap, mid cap, small cap, everything back to all-time highs. DJI, fresh all-time highs. IWM, massive strength again. So everybody calling for a recession, it just doesn't make sense based on what we're seeing price-wise. And that could change in a blink of an eye. I get it. But until that changes, it's hard to say, yeah, the sky is falling, the sky is falling. We're just not seeing it. Looking at the Qs, much like the SPY, just to me doesn't make sense really to trade this directly. I'd rather trade smaller caps or individual names that haven't moved since 2023. Most of this move in the near term is probably behind it. This probably needs consolidation before a considerable move higher. That makes sense. Again, it'd be broadening out. That's what you're looking for. On the Mag 7, NVIDIA getting a little bit of a down move today, some jitters into earnings. Whether or not earnings will be positive or negative, I don't know. I don't really care. But just looking at how this is set up, it's set up for another move post earnings like it was the last earnings. We'll see what we get. But I imagine a lot of people are trading around that specific date, and you're going to see moves around semis, around SMH, around anything that touches anything AI based on how those earnings come out for NVIDIA. SMCI probably done in the near term and the midterm and the considerable future as far as trading is concerned. You're going to need some sort of consolidation down here. The last consolidation failed, and this is obviously very bearish. Is it oversold? Sure, but the best moves you will always find on any chart are post multi-month consolidation. That's why I was a little hopeful that this would actually move up. It just didn't. So now you're going to need time for something like SMCI. Now it'll probably just move anyway with NVIDIA earnings, but again, when I'm thinking about semis versus software, SMH versus IGV, this looks like a blow off top. This looks like a parabolic rally. This looks like we're more likely to see broadening out into something else that isn't semis, and that could be software. IGV being one such ETF. Apple, much like SPY and Qs, it just doesn't really look appealing to me as a setup up here. It's been very choppy, very noisy. This could be a diamond top. This could be a head and shoulders. This is not what we saw in 2023. It's not just this continuous slow grind higher. It is all over the place. So is it bullish? Sure. But I don't see a trend per se there. Microsoft, same thing. Diamond top versus head and shoulders versus megaphone. Below the cloud, there's no clear trend here. So this would hurt the IGV thesis because I think Microsoft is in most of that. But the cloud telling you not yet on Microsoft. Amazon, kind of the same thing, just going nowhere, flat. Again, this isn't 2023 where it's just straight up. This isn't even into 2024 where it was just straight up. It's just so much chop. So much chop. And because of rates down, because of broadening out, I think money is going to find a home elsewhere outside of the top names. And that's what the charts are looking like. This isn't turbo bearish, but it's certainly less bullish than it had been when rates were pinned at 5.25 to 5.5. Meta, probably the only one that continues to look very bullish because of that ascending triangle potential, just sitting there at all-time highs. Of the Mag 7, this probably looks the strongest in the midterm, as long as it can hold that diagonal support. Google, again, it's like, yeah, it's fine. It's got some legal issues. Looks okay. But in the near to midterm, you're probably better off focusing on anything else that isn't the top tech names. Netflix, I don't really understand, because I thought if you go woke, you go broke, but it just keeps grinding higher. Yeah, the cloud has a hard time interpreting what the heck's going on here. It's bullish currently. It's just not really a chart for me, but it is in this multi-year trend channel at this point that just keeps grinding. I think it's obvious that they've won the streaming wars, at least in the near term. That's probably why they're doing so well, opposed to Costco, right? Which the cloud has called excellently since the breakout in 2023. This is what the cloud has an easier time with. Even though this is choppy at times, it still gets these bursts of strength, and it's coming up on another such burst of strength here, sitting at all-time highs. They're opening stores in Japan and China, and this company is just doing extremely well. For many people, obviously know that they shop there, but looks very good as a setup. On the cloud, maybe you get an inverted head and shoulders up here. No matter what happens, the cloud still likes it on the long side, for sure. As far as Tesla, so Tesla had this multi-month inverted head and shoulders. Everybody got super bearish on it, and it broke out. Okay, great. Now everybody got turbo bullish at 270, and it pulled all the way back down to the breakout level. So here, on low time frames, you do have a little bit of an inverted head and shoulders potentially to play. This measures above 270. I don't know why this would break out. No clue. But something to watch for would be a move above like 221. Maybe set alerts for that level and watch it there. But it does look okay on low time frames. I think the issue is the last move higher, it took 2 months of sideways before it moved higher. So this may be a little too soon. But if strength starts to come in at 221, I think that's a decent trade setup for higher. Here's IWM. It's it's all over the place. I don't know what this pattern necessarily is, but seeing 3 green weekly candles as strong as they were is huge. It's kind of the opposite of what we saw down here. There's this pattern on candlesticks, 3 rising methods, 3 falling methods. So this would almost meet that criteria for continuation, but outside of trend, there's not really, it's hard to know what the heck's going on here. You know, it's extremely volatile. So as an index, probably also not necessarily tradable relative to individual names that may be more clear cut on technicals. Uber's back to its 74 level. It still looks very strong. Cloud still likes it on the daily. If we do get a broad pullback into November, this is something to watch. but it still looks very strong as a trade setup, as a trade idea. Anything above 75, probably good to go to all-time highs. KWEB's just kind of stuck in the mud down here at 25 to 27, going nowhere fast, unfortunately. And that's kind of what you can get on some of these value traps, similar to Square. Just years of nothing, years of nothing. Square setting itself up for maybe a move towards the end of the year in Q4. Definitely put an alert at 77 on that one. For KWEB, I'd put an alert at 31. PayPal has finally started to move. Looks very good relative to those other two. I mean, this is what you want to see. You want to see not necessarily a new high every day, but higher highs rather than being stuck in the multi-year range. Similar to Pfizer, where it looks good enough where we're making these higher lows, but it's not yet holding on to those higher highs. So it's somewhere in between a PayPal and a KWEB. And then as far as the miners go, CORZ to me looks the best. I mean, it's real simple. Are you making higher highs or not? Are you at the top of your consolidation or not? Is your consolidation bullish or bearish? And despite my dislike for this company, this looks very good. And again, if NVIDIA's earnings are positive or whatever the market deems is positive, CORZ may move higher on that. And that eventually measures to a 2x from here. So if it can maintain this level and consolidate, it wouldn't be outrageous to see a move towards 18. So keep the doomers at bay for the most part. Despite cherry-picked data points, markets still look quite good. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.